Now let's talk economics. Let's talk about market cycles. Can you give us an overview of the different phases of them and tell us where we are on a macro level in the US right now?
Yeah, so there are 4 phases to the market cycle. Dr. Glenn Muller of the University of Denver created the current market cycles as we see them today. And I align with Dr. Muller's process to a point. So there are 4 phases to the cycle. We have phase 1, which is recovery. So think of coming out of the financial crisis in 2009-10, we started recovery. That is phase 1. So you have negative rent growth at this time. Your occupancy may start growing at this point, or you may be a little leveled off, but you're going to start growing your occupancy and work up towards phase 2. When you cross the line into phase 2, that line, so if you think of a box with the box divided into 4 quadrants, that lower left quadrant is where we're talking right now. As we go up a bell curve, we start to enter, we cross that center line where we enter phase 2, which is expansion. That center line is your long-term occupancy average. A market over a period of many, many, many years averages a certain level of occupancy. And the market cycles are based primarily on 2 things: that long-term occupancy and what's known as absorption. And I'll get into absorption in a second when we get into phase 3, where it really matters. So as we continue past that long-term occupancy average, go into expansion, the NOI is growing. So we have the vertical line of our 4 boxes and we have the horizontal line of our 4 boxes within that single box, creating the 4 quadrants. That vertical line, that represents your net operating income. So as occupancy is increasing and rents are increasing, your NOI is also increasing. You get to a point in expansion where it is now feasible to start building again. Developers can afford to build because they can get a profit, because rents are now high enough, or NOI is now strong enough to be able to produce a profit for developers. So now we're starting to build and deliver units to the marketplace. As demand starts to wane a little bit, meaning that as developers are delivering units to the marketplace, renters are absorbing those units. So absorption is end of year occupied units minus beginning of year occupied units. That difference is your absorption. So if you start with 100,000 units occupied at the end of the year, and you started with 10,000 units occupied at the beginning of the year, in that 12-month period, you absorbed 10,000 units. Well, if you delivered 6,000 units during that time period, you almost doubled your absorption over deliveries. So that shows real strong rental demand. That's the number 1 indicator for rental demand, is absorption. So when absorption starts to slow and go negative, that means you no longer have demand from renters. Even if people are moving to the market, that doesn't mean there's demand. That demand happens when absorption increases or decreases, which is lack of demand. So when we hit the very top of the expansion phase, that vertical line, and we cross over the vertical line into what's known as the oversupply or hypersupply phase, depending on who you talk to. Now, more units are still being delivered. Construction is still occurring, but absorption is no longer keeping up with deliveries. So you are absorbing less units than are delivering in the marketplace. And even though we may still have a little bit of rent growth at this point, rent growth is slowing. And then it gets to a point where rent growth actually starts declining. So as demand decreases, occupancy starts to decrease. And when occupancy starts to decrease, that's when rents start to decrease. And so those are demand supply fundamentals. So as occupancy continues to decrease, we then cross that horizontal line again, the long-term occupancy average, and we dip into what's known as the recession phase. The recession phase is the fastest phase of all the other phases in the cycle. So recovery typically can be 2 to 3 years. Expansion could be anywhere from 5 to 10 to 12 to 15 years, as we found out in this last one. Oversupply, hypersupply can be anywhere from 2 to 3 to 4 years. And then that recession phase typically is only 12 to 18 months. Once you hit recession, it goes really fast. And so you don't really have this perfect bell curve. What you have is a long, shallow slope to equilibrium in between phase 2 and 3. And then you start to get a little bit of a sharper curve until you hit that horizontal line again, crossing the long-term occupancy average in phase 3, going into phase 4, and then a sharp down spike and then back up the other side into recovery. So those are the 4 phases. Where we currently are across the country in most markets. Now, every market is different, but on a macro level, the United States right now for multifamily is in oversupply, barely above that long-term occupancy average. So it is deep into oversupply, hypersupply, whatever you want to call it. There are markets that have entered recession, and I study markets on my YouTube channel. You can search for it at David Monroe, CCIM. And of all the markets I've studied, and it's been over 50, there is only one that has gone full cycle and is now back on the recovery side, and that's Lake Charles, Louisiana. The caveat with Lake Charles is it's a one-trick pony, meaning it relies on oil and gas, and it relies on logistics and transportation because of where it's located. They got the port, they got the interstate, and then they've got all the refineries there. So there's not a whole lot of diversity in Lake Charles, so it is not attractive to a lot of investors, but they are in their recovery cycle. They're the only ones I've seen. Everything else is either in oversupply and deep into oversupply or into recession.
Great. I hope everybody's taking notes here. It's a lot of information. So here we are, third quarter 2023, and we're finding that the Fed has raised the interest rates, last one being on July 25th, another quarter basis points. It's the 11th time this year, and they may raise it again. How has all this interest rate increase activity been affecting the multifamily industry?
Those that have purchased on fundamentals, it's really not affecting them. They're seeing a little bit of a challenge, but they'll make it. They'll be fine. I'm referring to institutions, which are smart enough to purchase on fundamentals all the time. The syndication groups, what I call the student syndicators, they are in a bit of trouble because they have been purchasing on tactics and have used short-term floating rate debt to purchase from about 2019 to even today. They're still purchasing. They haven't learned their lesson yet. And so the few transactions that are occurring are still purchasing with floating rate short-term debt. It's the craziest thing I've ever seen. Well, let's think about back to COVID. COVID shut everything down from March to about August in most places. Alabama, we were live again in May, but most places, August, September, things started opening up again. Unless you live in California like Aisha does, and things didn't open until what, last week? Something like that. So in any case, coming to the third or fourth quarter of 2020, transactions really started to pick up because you had all this pent up demand to buy in 2020, but nobody could transact. And so when things started opening up again, that put a lot of pent up demand at the end of 2020, specifically in the fourth quarter. And to make matters worse, the gurus was telling everybody that they weren't going to be able to get bonus depreciation entering 2021 because the government had not made a decision whether they're going to extend it or not. So that just accelerated that demand to get deals done at the fourth quarter of 2020. Well, long story short, the government did kick the can down the road, did allow bonus depreciation beyond 2020, but that momentum accelerated into 2021. And it became really, really, really attractive to these investors. And they thought it was smart to purchase with short-term interest-only debt at 3.25%. They just thought that was the greatest thing since sliced bread. And what that did, and it was floating rate. So some purchased what is known as a rate cap. And what a rate cap does is it's an insurance policy on your debt. So it's actually provided by a third party. You still have to pay your debt. Your loan is going to go up. Your floating rate, if it's at 8.5% right now, you still have to pay that 8.5% interest loan. And then it's about a 2-week delay where your rate cap insurance will pay you back for the difference for that, whatever that lock was. So it was typically about a 200 basis point spread. So if you bought it at 3.25%, then you could have a ceiling of about 5.25% to 5.5%. And so you can get insurance beyond that, but you were responsible up to that 5.5%. Then whatever the difference was, that additional 2%, the insurance company, which is all it is, would pay you the difference, but you still had to pay the loan on time. Well, now rates are 7.5%, 8%, 9%, especially with the short-term bridge debt. The rates have driven up, and these syndicators are in a lot of trouble because they were anticipating a 4 to 4.25% refi or sell at the end of their business plan. And with the interest rates going up the way they have, that means in order to stay in positive leverage to be able to sell that property, then the cap rate needs to be above the interest rate on the loan, which means you don't have buyers for those properties. The other side of that is if you got this extension, because they called it a 3+1+1, those extensions, which these investors are relying on, are optional. They're optional both to the investor, they're optional to the lender. Do we honestly believe that if interest rates have doubled and the lender has fiduciary responsibilities to their shareholders, that they're going to extend another year for these investors at 3.25%? I don't think anybody believes that's true except for the investors that bought the loans themselves. So what's this going to do? Let me just give you the data and let the data tell the story. So TREP, who is the #1 data analytic company in the world for tracking the capital markets and tracks CLOs. CLOs are collateralized loan obligations, otherwise known as bridge debt. Mm-hmm. They have said that $12.5 billion in multifamily loans coming due in the next 12 months that are considered at risk, which means below the debt service coverage ratio of the minimum of the lender, which typically is around 1.25. $12.5 billion is between 1.0 and 1.25 debt service coverage ratio. That's not too bad because at least they're still making their mortgage payments. But they are at risk of being able to refi or sell, or even do a workout for that matter. What's worse, and this is the number that tells the tale, $23.8 billion. I said, you heard that right. $24 billion in multifamily loans coming due by the end of 2024 is below a 1.0 debt service coverage ratio, which by definition is negative cash flow. They are in trouble. And that is going to correlate into the largest bloodbath of foreclosures the multifamily industry has ever seen. And it all is going to occur along the Sun Belt because that's where all these properties were purchased.
Correct.
Mark my words.
Next year, end of this year, what do you think? Or is it hard to predict?
It'll take a little bit of time. Now, Arbor pulled those loans from that company in Houston, the 3,200 units, 4 properties. They took those back in a heartbeat. They gave them no leeway whatsoever. They just took them back, but there was preferred equity involved in those. So if you have preferred equity on top of in your capital stack, you are seriously at risk because they are not giving any leeway whatsoever. The moment that loan is due, they are taking the property back if you can't pay the loan. And that's what Arbor did. Now, these guys went delinquent because they weren't paying, they weren't doing their business plan, and they were trying to raise capital. There's all kinds of, stories about what went on about that. We're not going to go into that. But I think those were taken back a little faster than what we'll typically see for other CLO providers, which really is just private equity. I think we're going to see a little bit of a delay. So even though we're already seeing these loans in trouble, deals are already starting to come due for either refi, sell, or give the keys back to the bank. We'll see a little bit of delay, maybe a quarter delay. So I think going into first quarter 24, second quarter 24, we'll really start to see it accelerate, and it's going to last all the way through 25 and into 26.